Have you ever considered what would happen if the world ran out of oil? In the 1970s, this terrifying prospect became a reality. Picture this. The world economy, humming along, suddenly stumbled as the specter of a dwindling oil supply loomed large. The global economy, heavily reliant on oil, was growing robustly. Yet the ability to extract this black gold couldn't keep pace. This disparity sparked what we now refer to as the 1970s oil crisis. The immediate effects were swift and severe. Economies around the globe convulsed under the strain of escalating oil prices. Industries suffered, inflation skyrocketed, and ordinary people felt the pinch as the cost of living spiraled upwards. The world had been hit with a global economic shock of monumental proportions. The situation seemed dire, but then, a surprising solution emerged: energy efficiency. The oil crisis wasn't overcome by finding more oil but by using less of it. But how was this achieved? In the face of what seemed like an impending energy catastrophe, the world pivoted. The solution wasn't in the ground, but in our minds and our methods. We began to build cars, factories, and homes that were more energy efficient. Imagine that we didn't need to drill more, we just needed to use what we had more wisely. Take the United States as an example. This powerhouse of a nation now uses 60% less energy per dollar of GDP than it did in the 50s. That's a massive drop in energy consumption without sacrificing economic growth. And it's not just about big industry. The average Joe and Jane have played their part too. The average mileage per gallon of all vehicles on the road has doubled since 1975. In essence, the world grew its energy wealth not by increasing the energy it had but by decreasing the energy it needed. Just like the world economy, our personal finance can also benefit from the principle of efficiency. When you think about it, energy efficiency and personal finance have more in common than you might initially believe. Just as the world managed to grow its energy wealth not by increasing the energy it had but by decreasing the energy it needed, we can apply the same principles to our financial health. Investment returns can indeed make you rich. We've all heard the stories of people who bought the right stock at the right time, or invested in a startup that took off. But the reality is, the success and longevity of any investment strategy can always be in doubt. Market conditions change, companies rise and fall, and what worked yesterday might not work tomorrow. So, how do we navigate this uncertainty? The answer lies in efficiency. By decreasing the amount of money we need, we can make our financial health more resilient to changes in our income or investment returns. This means efficient budgeting and spending habits. It means living within our means, not wasting money on things we don't need or won't use, and making smart decisions about how we use our resources. It's like driving a fuel-efficient car. Sure, it's great to have a car that can go 200 miles per hour, but if that car only gets 5 miles to the gallon, it's going to be expensive to keep it running. On the other hand, a car that goes 60 miles per hour but gets 40 miles to the gallon is going to be much cheaper in the long run. The same goes for our personal finances. It's not always about making more money. Sometimes it's about needing less. So the next time you worry about your financial future, remember the story of the 1970s oil crisis. It's not always about making more. Sometimes it's about needing less.